Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for April 13th, 2021. I'm Ken Adamo, Chief of Analytics here at DAT Freight and Analytics. I'm joined, as always, by Dean Croak, who's our Principal Industry Analyst, and Ned Damon, who's our Principal Data Scientist. Welcome, guys, and good morning.
Good morning.
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 How's it going out there?
Spring is springing. We've got my fig tree has started to put out some leaves, so that's nice. I was a little worried. I'm not a real arborist, but trying to do stuff during the pandemic, we planted a fig tree, and it's a going concern.
That's good. Dean, welcome back. You traveled to your first in-person trade show last week, right?
I did, yeah. The Machinery Haulers Association conference in San Antonio. It was mixed feelings. Traveling again, was great to be traveling and meeting people physically, although the number of people sort of behaving as if there wasn't a pandemic was sort of surprising. Airlines do a great job. Airports are doing a wonderful job, but I think there's a whole lot of pent-up demand for people just to get back to some form of normalcy, which is great.
Yeah. I think we'll be talking about that over the summer.
Yep.
So we have a lot to talk about today. There's a ton of stuff going on across all of the modes and methods that we track. For those not familiar, we're here every Tuesday at 10 a.m. Eastern talking about things happening in the freight market. But most importantly, answering your questions. So if you have any questions, comments, or thoughts, please feel free to drop them into the chat or comment section below. We have an illustrious team of folks who filter through those and escalate them up to us, and they don't tell us the insults until after the show, so they don't hurt our feelings. So that's good. And with that, I'm going to get us to our key points of the week. So some really interesting things happening. We have dry van and reefer rates kind of middling about, which Dean will get into, and then Ned will follow up with on forecast outlook, but pronounced strength in flatbed. There's a lot of reasons why that's happening, and Dean will do a better job explaining that than I can, so we'll just table that for a second. But the kind of important takeaway there is spot rates higher than contracts for flatbeds for the first time in roughly 3 years, 2.5, 3 years. We have a lot of port activity. That's going to kind of be the theme for today's show. Ari Ash put out a piece yesterday. I recommend checking that out in the Journal of Commerce about Port of LA, Union Pacific reinstating surcharges in April, if you can believe it. I think it was $1,000 or $1,500, depending on shipper size for non-contract intermodal freight. And then just pretty much records across the board with port volumes. Hey, Dean, real quick, before we jump in, any lingering Suez Canal scuttlebutt?
Not on the East Coast, certainly. Right now in marine traffic, there's only 4 vessels at anchor off Savannah and 2 off Wilmington, none off New York, but 28 off Los Angeles, off the port complex there. So the big port congestion remains on the West Coast, where there's 8-day average wait time. There's a dozen big vessels waiting off Rotterdam right now, where a lot of those vessels were destined. You don't see a lot of those make port calls on the East Coast. Most of those Suez Canal vessels will do port calls in the Mediterranean, then head across through the Bahamas, into Mexico, up to Houston, back to Miami, and do that circuit. So we'll only see a very small number of vessels. I think the last data I read from Piers, the IHS market database, was about 68,000 containers tied up in at the southern end of the Suez Canal that were destined for US ports. So I'm not expecting a lot of impact on our ports. Certainly it's not visible at the moment.
Certainly an impact on the large multinational shippers that we partner with and who are our customers, but maybe just no direct North American impact. So with that, I'll turn it over to Dean.
There is one tiny note, I'm afraid. This is a very important episode. This is our semi-centennial episode, our 50th episode. And I hope that we can keep doing it for at least another 50.
That's 49 more than I thought they were going to allow us to do when we started this thing off, to be truthful with you.
Yeah.
So they've only gotten better, but the sky's the limit, I guess. All right, let's turn it over to Dean to get us into our market update.
All right. Yeah. General theme of this week's data set is decreasing spot market volumes in our top 10 markets, but increasing spot rates, which is a sign of how tight capacity is. So in the load board activity space on the dry van side, volumes increased for the third week across all of our 135 markets, moving up by about 3%. Similar increase in truck posts, so there was very little change in the load to truck ratio. Only dropped increased slightly. In the refrigerated sector, after 4 weeks of almost no change in the load-to-truck ratio, there was a slight decrease in load post volumes in all markets last week, so the load-to-truck ratio dropped to 10.64. Truck posts increased also, which could be a sign that capacity is easing slightly, but more likely carriers taking advantage of record high spot rates. In flatbed, volumes increased again for the 7th week in succession in the spot market, up another 6% last week. Truck posts increased by a little bit more than that, about 8%. So that had the combined effect of decreasing the load to truck ratio down to 94.59. But slightly less than 2018 levels. In the market condition index, lots happening in our top 10 markets. Volume dropped in all of our top 10 markets by one. Harrisburg was the only one that posted a 2% gain. Spot rates in the top 10 dropped by about 5 cents a mile to $2.50, excluding fuel. As has been the case for the last few weeks, capacity continues to tighten on the West Coast, where there's a lot of import volumes still flooding in. Los Angeles and Ontario load volumes dropped there, though, 12% week over week, which is a function of the congestion, irrespective of the volume of ships at anchor. Rates did increase, though. Even though volumes dropped in the spot market, rates increased by 4 cents a mile in both of those key markets, now averaging $2.90 and $3 a mile, respectively. Similar story in Texas. Capacity was very tight last week in Houston and Dallas. Volumes did drop by 3% week over week, but capacity tightened. Rates moved up 3 cents a mile to $2.15 for loads ex Houston and $2.05 a mile ex Dallas. So capacity is very tight down there, especially in the refrigerated sector, which we'll jump into. Load post volumes in the top 10 markets, again, tracked along with dry vans. Rates remain pretty flat at an average of $2.62 a mile. Produce markets, we can see some impact there of the season starting to take effect in Miami, Fresno, McAllen, Laredo. Even though load post volumes were down, capacity was very tight again. Rates were up in all of those markets, much higher than they were in certainly compared to March rates. Capacity in Texas generally very tight across all of the markets. I think there's 11 that we track there. Rates increased for the 3rd week in a row. They're now up 2 cents a mile to an average of $2.57 for loads outbound Texas. Capacity is very tight in the Pacific Northwest, which is unusual in the refrigerated space. We are seeing some higher port volumes migrate further north to Seattle. And there was a 25% week over week increase in refrigerated load posts last week. So that drove up spot rates to 42 cents a mile to an average of $2.14, which is important. That's a pretty strong backhaul market, although 10% of those loads were heading out to Spokane east. Capacity was very tight on that lane. It's only 280 miles, but rates are up 86 cents a mile compared to this time last year. On that lane, they're averaging just under $4 a mile. In the flatbed market, volumes increased slightly again. Spot rates decreased from the top 10 markets by 2 cents a mile to an average of $3.24. So capacity is still very tight when you look at those rates year over year. But the average hides some wild fluctuations in spot rates and volume and capacity. So take Decatur, for example. It's our number 2 market. Volumes dropped 7%. Rates plummeted 50 cents a mile to $4.13 from a similar increase the week prior. Further east in Charlotte, load volumes dropped 31%, but rates headed in the opposite direction, increasing by 20 cents a mile to $3.31. As always, flatbed volumes in Memphis, that's our number 1 market. Load post volumes increased 20% last week. Capacity was also very tight. Rates are up 2 cents a mile to an average of $3.35, excluding fuel. Wrapping up with our year-over-year look at spot rates, as you can see from our chart, we're still at record high levels for this time of the year. But spot rates in dry van did reverse course last week. They dropped 4 cents a mile to end the week at $2.35, excluding fuel. Just for for context, if you compare this to the same week last year, this was the time when freight demand was crashing and the pandemic lockdown took effect. Rates are 82 cents a mile higher than this week last year, but they're also 84 cents a mile higher than this time in 2019 and 48 cents a mile higher than this time in 2018 when capacity was not quite as tight as it is now, but one of the tightest in the last decade. In refrigerated, fewer refrigerated load posts last week had the effect of pushing down the refrigerated spot rate by 4 cents a mile to $2.62. Comparing it to 2020, rates were $1.78 a mile this time last year, so they're 84 cents a mile higher. and remain at record levels, as you can see from our chart. They're even 51 cents a mile higher than this time in 2018, which is the blue line on the chart. And lastly, in flatbed, spot rates have been on the rise since February in flatbed. They increased another penny per mile last week. They're up to $2.50 a mile on average, excluding fuel. To gauge just how tight flatbed capacity really is, if you take a look at the first half of 2018, and that was often described by experts as the tightest in a decade, and it was a flatbed-driven rate rally. And that sort of stayed, contract rates stayed above spot after that peak in June. They've just gone back in the other direction. So now we've got spot rates for flatbed crossing over above contract just by a few cents per mile. But generally right now, if you look at the blue line and the red line, flatbed rates are currently 23 cents a mile higher than where they were in 2018, with spot edging above contract for the first time. So that's it for this week's market update. If you'd like to know more about what we're talking about in the freight market, go to dat.com/market update and download our written report. So that's it for the market update. Over to you, Ned, to see what's happening in the rate forecast.
Roger, Dodger. So we're going to begin by looking at the dry van forecast. So you can see in blue the market rates measured by DAT. And then off to the right, you can see our spaghetti strands of models. We have 4 that we run for this. We have a short-term model. In red, we have our flagship RateCast model in green, and we have 2 blended forecasts in gold and silver that are mixtures of those 2 models in different amounts and in different ways. You can see that there continues to be broad model agreement, with the RateCast model expecting rates to continue to abate slightly and then flatten out by the end of April, whereas the short-term model is expecting kind of a flat pattern going forward, and the blended forecasts are kind of straddling that middle space. Moving to reefers, again, blue is the market rates measured by DAT, and then off to the right, you can see once again there's pretty broad model agreement across our suite, with short-term expecting things to continue pretty flat into the beginning of May, whereas RateCast is expecting a slide and then a rally as we move into May, and the blended forecast trending a little bit more towards the RateCast way of looking at things, at least during that period. In contrast, flatbed, there is broad model disagreement, which I suppose is not surprising given its semi-explosive growth. Once again, you can see in blue the market rates measured by DAT, and then on the right you can see our short-term continuing that up and to the right trend off towards 270 a mile into the beginning of May, whereas RateCast is hoping that more traditional pressures might hold it lower. But we'll see what happens. And then the blended forecasts are trending more in the short-term direction, I think for reasons that should be clear given the success of the short-term model over the last couple of weeks. That is about it for the forecast. And now I'm going to turn it over to a historical Ken, interviewing somebody very important to the freight market space.
What does it take to pull up to a dock and receive that kind of freight? Because contrary to popular belief, it's not the same type of training or equipment or expertise that hauls sort of generic refrigerated goods. Can you just talk a little bit about how you approach, as a company, qualifying these folks to handle these types of shipments?
Well, there's a couple different things. There's capabilities that you need from a truck standpoint. There's skills and knowledge that are needed at the independent contractor standpoint. And then in our back office, there's a need to have quality that's really set up to support the healthcare provider and providing them with information that will ensure the integrity of the things that we're shipping and that there's no compromise to them as well. And so it really sits with those 3 facets of our quality and continuous improvement, the knowledge and skills that are within the independent contractor, and then thirdly, the capabilities that come with the vehicles that are used for those type of shipments.
Yeah, that was a really great conversation. That was just a small piece of the broader conversation. I think it comes out tomorrow. I'm looking at it comes out tomorrow. With all that's going on with the vaccines and expedited freight, I really recommend giving it a listen. We'll promote it out through our channels, but For those who don't know, Ramona Hood, President and CEO of Custom Critical, my former boss, has spent the better part of 30 years in the industry, knows it in and out. And I think it was a really great conversation about leading through COVID, expedited shipping, and most importantly, transportation of vaccines, pharmaceuticals, things like that. So with that, I'll turn it over to Ned and hit us with our Ask IQ question of the week. And while he's pulling that up, any questions, again, please drop them into the comment section below, and we will get to those shortly.
So this question has to do with these record freight volumes that we're seeing at West Coast ports, and what is driving the boom in imports is the question.
So
Dean?
I can. We just had a look at the latest peers database for March, and it shows a couple of interesting things. The Port of Long Beach just posted a record number of container moves for March. That broke a 110-year record. And then why that's important is March is typically the slowest month on the ocean shipping calendar. So we normally see a big drop-off after Chinese New Year, and then volumes pick up into the summer. But they're breaking records, like all-time records on the West Coast. So looking at the numbers, this is the number of containers that came into the US in the month of March compared to the month of March 2020. Total container volumes are up 57% year over year nationally. On the West Coast, up 70% year over year. So they're up substantially on the west side of the country. East side of the country volumes are up 40% also. So records being set at a time of the year when freight volumes are normally low. Of course, we've still got inventory levels being replenished, so there's still a lot of backlog of freight making its way across the ocean through congested ports, moving its way inland. Warehouse capacity is very tight. So the general consensus is, when you talk to the ocean experts, is a lot of this is still the rebuilding of inventories that were severely depleted from 2020.
I'm always nervous about having year-over-year comps right now, given how kind of goofy things were. But I think it's pretty clear that this is not just a statistical artifact of what's been going on.
Right.
Do you think, I mean, given that the volumes are so high during a relatively slack period, do you expect that as we move forward into a more sort of normally high volume periods, that there's going to be increased congestion, there's going to be a need to reroute shipments to other ports? I know you mentioned earlier that, for example, Port of New York had no ships at anchor, whereas Los Angeles was very high.
Yeah, the ports that have invested in deeper draft measurements for ships and raised bridges like New York has, they've benefited from being able to process a lot more volume. New York's pretty efficient. There's also been a lot more volume move away from Los Angeles to the extent it can. So remember that a lot of that volume on the West Coast, they're very large TEU vessels. So, but the largest vessel that can go through the Panama is about 14,000 TEUs to run up to the East Coast. So a lot of those big vessels that you see at anchor right now today are only running the Trans-Pacific trade lane back and forward. So that congestion, those ships don't have a lot of other places to go. They could go to Oakland, maybe up to Seattle. So the smaller vessels, they can reroute around to Houston, New Orleans, Miami, etc. And that's already been happening. That's been ongoing since November. The number of vessels today is 28 at anchor. It was 40 back in January. So it's getting better. They're getting more throughput, but there's still a lot of congestion on the land side. That's where the big issues are. On the dock, the port side, the chassis trailers, turn times for containers, and then warehouses are extremely full. So and then you add the pandemic on top of that and the social distancing requirements of the longshoremen, and you have all sorts of congestion right through to the ships coming in at anchor right now.
I mean, the other thing that Ken mentioned right at the top of the show was that the Union Pacific Rail surcharge. I mean, that's going to, what kind of an impact is that going to have? I imagine it's going to make it harder to clear inventories out of warehouses and get it to distribution centers where it can get moved further.
Yeah, it's just like there's a confluence of events here that are really unseasonal. The truckload capacity is very tight for a couple of reasons. One is it's getting tighter on the West Coast, but nationally it's getting tighter because there's fewer drivers. There's more competition for drivers from other industries. You've got the Drug and Alcohol Clearinghouse keeping about 50,000 drivers from returning to work. So there's things happening now that have never happened before. So you've got a tight capacity situation, and then you've got this surging volumes coming in that it's overwhelming the ability of the port markets to handle it. So there's going to be a lot more of this all the way through to June. Gene Soroka at the Port of Los Angeles is indicating that this congestion levels are going to continue well into the summer before we start to see any sort of let up in the just the volume of containers coming in.
If good news to you, right? Because I realize that we're talking to like very different ends of the market here. So I'll caveat good news as things softening a bit. There hasn't been that much to go around, right? So you might think, well, Class 8 truck orders came in for March up 400 and some percent, was it? I'm looking over. Yeah, I think it was over 400 and some percent up year over year. And then I think the very next day, there was a news article in the Journal, I think it was, that said the chip shortage is going to cause OEMs to build and park trucks until they get the necessary semiconductors in, which it will delay orders being placed today and beyond well into 22. So help on the way in that regard.
I mean, I think another question is, given the driver shortage, I mean, you need two parts to make the truck go. You need the truck and you need the driver. And so if drivers are going to be the limiting reagent, then, a big increase in trucks aren't necessarily going to translate into much reduced capacity. But I might be
I'm not concerned about that. I mean, I think you might have like a short-term weird thing where like immediately you might have some trucks parked, but I mean, it's very rare to take delivery of a new truck and park it up against a fence. I just don't see it. I mean, Dean, you know it better than I would, but I just don't see that happen. I think they will fill the seats within a few months of the capacity coming online.
Yeah, I think there's, capacity always takes a while to catch up to demand. I'm really concerned, though, about the impact of the pandemic on the driver supply. Driving schools have been restricted in terms of processing a lot of new entrants, but you've also got a very tight labor market, and you've got a lot of competition from other jobs closer to home for the typical driver pool. And then just sort of looking at the macro level, the demographic that we pull drivers from is decreasing. So you've got some things compounding this at the moment that are making it very hard for fleets to seat trucks. And I just don't know that that's normal seasonality. Like we go through tight markets and loose markets. This is different because there's a very tight labor market for all industries, and then we've got a lot of pent up demand that's going to drive a lot more activity in the second half of this year, and of course we've now got concerns about how do we get drivers in trucks to meet this demand at the back end of the year when it's already tight now. That's my biggest concern, not so much about the truck supply side. It's more about the driver side. I talk to a lot of drivers every day, and there's a lot of them are very comfortable making $25-$30 an hour driving triaxle trucks around town delivering dirt. There's not a lot of need to go further than that.
Should be interesting to watch. I mean, we mentioned year-over-year comps. The last thing I'll bring up before we get into general questions, we were pulling some of the year-over-year comparisons of total load posts on our load board, and those numbers were just insane. Well, I mean, the total across all three equipment types, Dean, was up, 700% year-over-year?
Yeah, phenomenal. And this was sort of comparing to the bottom of the demand crash during the pandemic last year.
Right. Reefers were just like a few points shy of being up 1,000% year-over-year, if I remember correctly.
That's correct, yep.
997% increase year-over-year in load posts.
Yep.
So that is, if that gives you any sense of what's happening in the markets out there, I should say if that doesn't give you a sense of what's happening out there, I really don't know what will. Ken,
if you look at, if you think back to 2018, which was a pretty busy year in the flatbed market, we had, there's still about 30% higher than 2018 right now in the flatbed space.
Yeah, I mean, I probably said it no less than 500 times since joining DAT that I'm very sympathetic of those that have to move freight right now, but I'm kind of selfishly glad it's not me. Right? I mean, it's just, I was talking with a government agency yesterday about some of the intermodal and port issues, and it's like you're kind of 3 steps away from being able to, like, 3 major problems right now are standing between you and moving freight, right? So can I get anchored and get offloaded? Well, no, that's delayed however many days. Can I get offloaded and can I get drayed? Well, there's a chassis shortage. There's all these other compounding factors to get it drayed. And then once I get it drayed, do I have warehouse space to put it? Right? Or I can't transload it. I can't do any of the typical mechanisms that would facilitate me getting my freight from a boat to a store shelf. And I was on a really great webinar earlier this week, or was it late last week? Regardless, with Bumblebee Foods, and they mentioned that they're rebidding every one of their lanes every other week, 400 lanes every other week, and they have been for the better part. I forget what she said, but it was for a while now, and they expect it to continue, and that is 100% service, right? That is not rejectable freight. So to be continuously, that's for all effective terms, that it's continuous procurement, right? When you're rebidding out lanes every other week. And that is just a remarkable feat on 400 lanes for a shipper to have to do that. And frankly, for brokers and carriers to have to respond.
Yeah, no, I was going to say it would be really helpful to have a tool that would assist you in pricing your RFPs at a market equivalent rate.
I don't care what they say about you, Ned. There's a little sales in there. It might be mostly data scientists, but there's a little bit of sales. Yes, to Ned's point, we did recently launch multi-lane download for Ratecast. We've always had multi-lane download. It's been around for 10 or so years. But now you can run Ratecast through it, which gives you a forward-looking view of RFPs. We already have tons of folks using it, and they're seeing tremendous success with their RFPs, right? Because it's kind of inherently chronologically sandbagged, because if you're using year-over-year comps right now, or you're using historical data, you're going to kind of be in a world of pain. I also think there's free trials going on. I think, again, I'm a little bit more removed from it, but I'm pretty sure if you have RateView, you can get a free trial for Ratecast and kind of run some RFPs through it. But check in with your sales rep or customer service if you have any questions about that.
I think you used the F word that some members of our sales team really, really don't like, but I think
a complimentary trial.
Shall we
you want to hit us with some questions?
Yes, absolutely. Gary asked, how do you measure flatbed trailer width? Outside the rails? Dean?
That's a great question. Yeah, it's outside the rails.
Outside the rails?
I don't even know what the rails are, so.
It's actually... Yeah, it depends on the design of the trailer, but generally it's the load carrying piece as opposed to the thin rails where you hook your straps on down the side. So I'm not sure that's a trick question, but that's my best answer.
They seem like they're out to get you, Dean, because I wouldn't even know like what they're talking about. So that one's all you.
Yeah. We'll find out
From
later.
Daniel, having trouble...
Sorry.
From Daniel... I'm trying to blitz through these so that we can get everybody's questions answered before we have to go. Having trouble moving van partials with long miles out of the Northeast, which usually move pretty quick. What's happening over there? Anybody got a hip
I can
shot?
take this one. Check out my LinkedIn. It was a post last week. Really great discussion amongst my network. And we pulled a very similar lane. I think it was Elizabeth, New Jersey to Chicago, but I could have picked really anything on that any of the key markets in the Northeast. Those are typically autopilot lanes. That's what I would call them. But you mentioned they usually move no problem. There's been an incredible disruption in a decoupling in that data, right? If I were to pull any year basically from 2010 to 2019, or even 2020 for that matter, that lane would typically move at a pretty set rate. The first 3 months of 2021 have seen a major shift. So there was some supporting data, some commentary, and then a ton of really great back and forth in the comments. So I recommend check out my LinkedIn profile, and it should be the last post that I made. I think it'll show you some of those data points. And if you have any more like specific lanes you want run, just hit us up at askiq@dat.com or message me or Ned or Dean directly on LinkedIn, and we can get that pulled for you.
Absolutely. I'm gonna do things out of order slightly. Corey asked, "What do box truck market look like?" I don't think that we have a good answer for that. We don't have. That's something that we're continuing to work on to get a better picture into box trucks and hot shots and other kind of non-traditional. Or I guess they're more traditional now, but at one point they were non-traditional equipment types.
We're working on a bunch of things, right? So sometimes the wheels just move slowly. We're very busy as well. But we're trying to get through some of this. So there's been a lot of questions about the auto industry and some of that supporting. So we're lining up a guest to come on, CEO of an auto hauler, to come on and talk to us about what's going on in the auto industry and all things surrounding that. So we're trying to, if you know anyone who has box truck expertise, please drop us a line. We'll reach out and be happy to sit down and have a conversation with them. We're definitely open for learning.
Gary asks, so will Texas rates boom because the move to Mexican ports due to U.S. ports having too small, what's the term? Like the port depth?
Yeah.
Draft.
Yeah. Thank you.
I think it's Lasagna Carenas is the only deep water port that they've got in southern Mexico. It's serviced by a couple of Class 1 railroads. So there's a possibility we could see some improvement in volumes. We saw it before the 2018 tariff on Chinese imports was imposed. There was some rerouting of vessels via Mexico to avoid the import duties that way. Didn't see a big hit in the volume on the truckload load boards around the border crossings, but we're already seeing pretty high volumes of auto parts and just electrical goods and all sorts of parts made in Mexico because of nearshoring as supply chains build more redundancy and have more plants closer to the US. So I think that's more likely to drive more volume as opposed to the port congestion, which will eventually clear itself.
Just one kind of extra question on top of that. This is from me personally. Do you think that the big Central Pacific merger that's happened, that it kind of increases their reach down into Mexico and north into Canada is going to increase rail freight moving through that?
Yeah, because you'll have more seamless cross-border moves. You won't have to be, trucking freight north of the border, then putting it on an intermodal move. You can do that move straight from within Mexico with the merger. Yep.
Final question. Chad asks, I like the idea I proposed to Dean last week of using a DoD model to fill loads at market rate instead of an RFP.
Yeah, that was on the Mad Gaines show, that one.
Well, I'm glad that Chad likes his idea. No, I'm just kidding. So I have maybe I'm uniquely close to this where I had responsibility for pricing into the DoD system in my prior life. I think it's a tremendous level of transparency that really only the government can provide. And I say that with a bit of an upward inflection, right? It's FOIA-able information, right? Freedom of Information Act, it's the government. They have, though, struggled to get the improvements that they've been promising to that system, right? There's been some FAR-based independent contractor concerns as it relates to that. Maintaining those tariffs, especially if you're heavy into the dromedary class, moving that stuff around can be difficult. So I do think it's a good idea. My thought, and maybe I'm just personally jaded, is the scale that would need to be leveraged. I think there's a lot of other ways, like indexed-based pricing. We're seeing a lot in our roundtables and other conversations of shippers and carriers entertaining the idea of index-based pricing, even if it's just like quarterly, for example. So let's just say that you're a carrier, and between you and the shipper, you agree to peg to the DAT regional or national line haul rate, and you'll adjust it monthly, semi-monthly, or quarterly, right? So if the index goes up 10%, your contract price might go up 2 or 3%. There's usually always a buffer. That's a really popular concept from my days in energy. You would do that all the time. You'd call it a market stabilizer. Or you would do like block fixed and variable contracts where you might lock in 70% and leave 30% to float. It's starting to catch on a little bit in trucking, but it'll be really interesting to see what happens with that over the next couple of years because we're hearing more and more about it. Anything to add?
My experience working with government contracting in a prior life was that when you have things that are that transparent, there is a real risk of people gaming the purchasing in a way that is not necessarily ideal. But
Yeah, I mean, it's really interesting the way they go. I mean, you could go every month, you'd get, and I forget the name of it now, some crazy government acronym. You would get every single carrier that moved DoD freight and how many loads they carried, sorted in descending order. And then at any point in time, you'd be able to go in and pull your tariff on a specific lane compared to everyone else. So it might say you're 4th out of 11 on this lane, or you're 3rd, and then you go update your price, and then it would tell you where you now ranked. Now, I've been out of the game for a year and a half now, so it may have changed. I doubt it with anything like the government. I doubt that it's changing that fast. But it is a lot of people. There's a like, again, anything with the government. To interact with the government, you have to build an apparatus internally to facilitate that and to do audits. And the DoD fuel is notoriously awful, right? Their fuel scale is terrible for carriers. So, no offense to the DoD. I mean, I don't want like an accidental unexploded ordnance showing up in my yard, but again, no offense to the government, but yeah, there are some quirks there that were always very interesting and head scratching. If we had more time, we could talk about the GSA. That was even more fun to deal with.
Oh boy. No, I remember that.
Well, hey, I'm going to wrap us up for this week. I know we're running a little bit long, but the questions were really great. If you have any more follow-up questions or comments, or a box truck expert, I know we already got one submitted, please let us know. Some recommended things to check out. Freight Focus comes out tomorrow with Ramona Hood. Again, really great conversation. You can skip through the parts where I talk and just listen to her if you really want to kind of make most efficient use of your time, because I do think it's very insightful for folks in that smaller equipment or expedite industry. Freightvine podcast with Chris Kaplis. I think a new one comes out next week. We have Dean's Market Update that's posted every week on our website. And I think that's it. I'm sorry if I forgot anything, but we'll be back next Tuesday at 10 Eastern, and we'll rectify any of our mistakes and try to do a better job next time. With that, bye, everybody.
Thank you.
Continuous improvement. Bye, all.
Bye.